I am the tall person in my family. My mom is 5 feet tall, and my dad is 5'2". So with me being almost 5'9", I am 7 inches taller than my dad and 9 inches taller than my mom. So from the family I grew up in, I was the tall person. Now, I actually didn't think much about my height growing up until I moved to Asia, which you would think, oh, Asians, generally speaking, are not as tall as, North Americans. But what's interesting is when I lived there, and I lived there over a period of 3 years, most of my friends were from Northern Europe. So one day I was just standing around and noticing that, my friend from Norway and Denmark, and even though Holland is not Northern Europe, I would just look around like, wow, okay, like everyone's much taller than me. And so it was really interesting that it took me to living in Asia to be like, you know what, I'm not that tall. And though I said to you a moment ago, I never really thought about my height, I was never a big kid growing up. I was very scrappy. I had exceptional balance, and I was very aggressive when I played soccer. But I was drawn to people who might not have been that big. So Bruce Lee was a hero of mine growing up because he was a slight person, and he was very good at what he did. And another person that I was drawn to was Prince, the musician, because he is also, I actually don't know how tall he is, but I think he's like 5'1", 5'2", something like that. So I always found it interesting how height does or did play a role with me and my beliefs. And it's interesting, it's not just me. Even living in India, when I lived in India, there was definitely this thing about height. You looked at all the police officers, and all the police officers were always over 6 feet tall. It's such an arbitrary thing, but it's something that's stuck in my mind. So there are a couple arbitrary things that are not going on. They are doing it in unison, and it's a repeat of what happened 16 years ago. So with that, I've come up with a general theme for this weekend. Hey everybody, this is RC Peck, and this is my weekend podcast, episode 329. And the theme this weekend is, I don't necessarily need to say party like 1999, but I'm going to say 1999. There are three major indices that are bumping up against a 16-year-old ceiling. One I talk about a lot, and that is the SP 500. That has greatly broken above its 1999 and 2000 price point. But I want to point out three other indices this week that are acting very differently than the S&P, and look to them to tell us what might be happening. So the first one I want to show you is the S&P 500, but I want to show it to you inflated, adjusted for inflation. So if you look at the screen, and if you can't, I'll describe it, you see a price chart of the S&P 500, and the price today is below the price where it was in 1999 and 2000. And why I find this interesting is for two reasons. One, inflation actually hasn't been that high over the last 16 years. And in fact, inflation, depending on how you measure it or who you look to measure it, definitely if you look to the government, it is very low. But even if they are correct, this is one of the reasons why many people, are not feeling richer. And it's because maybe the dollar amount in their account is higher, but what that can actually buy for them has been limited, right? Especially if you have kids in college or you have healthcare costs. Those two numbers, the inflation rate around those two numbers has been extremely high. So the first chart I want to show you was a very kind of zoomed out 20-year chart of the S&P 500 adjusted for inflation. Very interesting. We're bouncing off the same point we bounced off in the year 1999 and 2000. And even in 2007, you can see that it was much below the actual price of the 2000 number. Okay, the next of the three indices is an index called Value Line. Now, the Value Line Index is interesting because it takes the 4 largest exchanges in North America. If you don't know what the 4 largest exchanges are, it's the Amex, the Nasdaq, the NYSE, which stands for New York Stock Exchange, and the TSX, which is the Toronto Stock Exchange. So it takes those 4 indices or indexes, tomato, tomato, and it puts them on one plot line. Now, this is not adjusted for inflation. This is actual price. And, I hesitate to call it North America because I do understand that Mexico is part of North America. But as far as like developed world North America, this is the price chart you have. And if you notice, it peaked out at the beginning of 2015, just where it peaked out in 2007, and just where it peaked out, in this case, in 1998. And it's doing it again. Now, what I find interesting, one is that it's peaking out just like it did in 07 and 98, but also that it peaked out before the SP 500. So if you see this back in 1998, it peaked out. Now, the SP 500 didn't peak out for another year. Sorry, actually for another 2 years. So this started moving down 2 years before the S&P 500 did. Super interesting. And then if you go to 2007, this index peaked out a whole quarter, 3 months before the S&P 500 did. And then if you fast forward to just last year, it peaked out at the beginning of last year. So at least over the last 2 decades, the value line geometric index has peaked out for sure in 2007 and for sure in 98, 99 before the S&P did. And here it is peaking out again at the beginning of last year. So this is clearly sending a signal to be cautious, just like the S&P over the last 20 years adjusted for inflation is sending a signal to be cautious too. And then the last price chart I want to show you is the Nasdaq. And I want to show you the Nasdaq for a couple of reasons. One, living in Silicon Valley, this is probably the index that affects Silicon Valley the most. But two, it never got back to its high in 2000, 99, 2000, in 2007. It was significantly below it, about 45% below it. And just recently, at the end of last year, it got back to the price it was in 2000. So all those people who bought and hold are like, yeah, see, I got my money back. What they don't recognize is it took them 16 years of their life just to get back to where they were in the year 2000. But the other thing I want to point out on this price chart, and just, this red line is a 200-week exponential moving average. But what I want to point out is it's hard to see maybe on your computer, but right up here over the last 9 months, there's a pattern, and it's a topping pattern. And this topping pattern is called a head and shoulders topping pattern. And it's typically associated with reversal patterns, or patterns that reverse a long trend. And in fact, that is what's going on right now. So you have 3 major indexes on the planet, one adjusted for inflation, one looking at the most developed 4 largest exchanges in North America, which has led the move down in 2000 and 2007. And then you have the Nasdaq here that has a topping pattern. Now, let's be clear. We don't know what's coming, right? But what we know right now is what we have. And when you look at just this price chart right here, the Nasdaq, we're looking at hundreds of millions of people who are voting by looking into their future and saying, is the future a little safer? Am I being a little bit more optimistic? Should I be more optimistic about the future? And if they are, they buy a little bit more. And if they're feeling a little less optimistic or negative about the future, they either stop buying or they actually take some money out of the market. So I will continue to watch this, but for sure we have 3 major indices topping right now, potentially telling us to be cautious. Well, they are telling us to be cautious. So the takeaway, I just said it, the big picture, at least from the 3 indices that I'm looking at, is telling us to be cautious. Now, 3 things. 1, central banks need to do more. Yesterday, they don't really need to do more, but yesterday, the Japanese central bank came out and said, we're not going to do more right now. And as soon as they came out and said that, the Nikkei dropped 3.6% in one day, and the yen skyrocketed upward. And it did skyrocket upward. It's been moving high. It has broken out of its channel and is moving higher. The reason why you should care about the yen is historically over the last 2 decades, when the yen has moved higher, that's because people have been moving their money into the yen because they've been concerned. And even though Japan is literally a dying country, it is still the 3rd largest economy on this planet. So central banks need to do more. And the Japanese central bank came out and said, nope, not right now. And it might have even been the same day or maybe the day before, Janet Yellen and company came out and said, we're not doing anything with interest rates right now. So you have 2 of the 4 biggest central banks on the planet saying no for now, even though they're still doing things. They're just not increasing their insanity. So I will stick to this belief that the market can only go higher on the back of central banks. And right now, central banks are not doing what needs to be done to move the markets higher. The other thing is gold broke out. It was in a sideways channel. It was consolidating. It was digesting its very huge move. It could have broken down. It could have broken to the upside. And what it did was it digested that move by going sideways, meaning it digested it through time and not through price. And that is significant because gold, silver, mining shares, they're all overbought, and they're getting more overbought. And the thing about overbought is things can stay overbought for a year, just like when oil started falling in July of 2014. It did not stop falling for a year, and it stayed oversold in that example for 9 to 12 months. So assets and ETFs and sectors and commodities can stay overbought and oversold for long periods of time, and that's something that you have to remember, that anything can move higher or lower than you could ever imagine. And then lastly, during this whole thing, bond prices just continue to trend up. The long-term U.S. government bond, the 10-year U.S. government bond, from a price point of view, they continue to just be trending up. Not every day, not every week, not every month. But when you look back and you look at it on a yearly basis, you see the price of them keep going up. So the takeaway is stay cautious. But even more importantly, and I talked about this in my Peak Gold training webinar that I did last week, and if you want to write anything down from this week, you write this down. You buy strategies, not stocks. You have to understand the strategy behind your behavior, behind your action, because it's that thing that you're actually buying. And most people who are buying individual stocks or even gold or silver or oil or whatever, they think their strategy is, oh, I'm just going to buy energy or I'm just going to buy gold. And that is a huge mistake. Whether you believe gold is going higher or not, it is actually going higher. And those who say they should own gold because they're worried about the world ending, first of all, that's a really bad strategy, because so far over the last 5.4 billion years, the world hasn't ended. And over the last 120 years in the U.S., this economy hasn't ended either. So the takeaway, or kind of this meta or macro takeaway, is you want the strategy. The strategy defines your outcome, not the stock. Okay, guys. Thanks so much. This is just another step in helping you protect your future and protect your portfolio. Until next time, this is RC Peck.